We lost all, and I'm not joking, we lost every of our team members except one.
Wow. Wow.
So I think accountants have to do better in really being humans. Yeah, so we project our fear of money on people. I think that's the worst of our culture. And the reality is there's just this love-hate relationship with tax with most entrepreneurs. Now, most people go into business not having the right mindset about taxes. I always say to entrepreneurs, because I distinguish between an entrepreneur and a business owner. Anybody can have a business, and your business could be profitable, right? It does not make you have an enterprising mind.
Welcome to The Business Game, a podcast that moves the needle. Hey guys, before we jump into today's episode, we just wanted to take a really quick moment to thank one of our sponsors, Tala Offshore. For any businesses wanting to maximize their return on new hires, Tala offers seamless access to top-tier Filipino talent who are real employees hand-selected by the Tala team, slashing your staffing costs by up to 60% with onboarding in under a week. Visit talaoffshore.com to scale smarter, and thanks again to Tala for supporting The Business Game. Hi guys, welcome back to the show. My name's Jazmyn.
Hello everybody, and my name is Kevin.
Before we begin today, remember to hit that subscribe button and like, and leave a comment if anything pops up on your mind during the episode. We are joined today by Michael. Welcome to the show, Michael.
Thank you, Kevin. Thank you so much. Appreciate both of you having me on your show today.
We are so excited because you have some really incredible success stories under your belt. Could you give our audience a little bit of information about who you are and what you do?
I always describe myself, first of all, as a serial entrepreneur who happens to be a certified public accountant. Okay. And that's very intentional and purposeful, because there's a difference between what the typical CPA is and what most entrepreneurs are. And hopefully, in the course of our chat today, I would be able to unpack what that really means. But I seriously, with my wife, I am the co-founder of Six Successful Enterprise. No, most people know me primarily through the CPA practice, but my wife and I, we are both investors and founders of a telehealth application that is being deployed now in the largest Black nation in the world, which is Nigeria. And as we speak, we are getting ready to roll up another tech app, amongst many other things. So that's why I say I am, first of all, a serial entrepreneur who happens to be a certified public accountant.
That is awesome. I think that a lot of our audience can probably relate to that, where you've got to have that entrepreneurial spirit driving what the formal title is at the front of it all. So let's start off with a bang here. I'm going to put you into some opinions to start off with. So the Wall Street Journal says that the new federal tax law from the One Big Beautiful Bill Act is creating a cash windfall via 100% bonus depreciation and faster R&D expensing. If you were advising a 7-figure founder today, what would you accelerate before December 31st to capture those benefits, and what placed in service or basis pitfalls should they avoid?
That's an interesting question. I did a webinar last week, Thursday, on the One Big Beautiful Bill, and I think it's available on YouTube. I will double check to make sure my marketing team has put it out there. So every of the questions you just asked were some of the key case studies that I did in the course of the webinar. And the reality was that the case studies that I did, I used real life client situations, just keeping their names out of it. Now, when advising any entrepreneur as it relates to the One Big Beautiful Bill, I definitely would be recommending to them that they review whatever their capital investment plans are for the year 2025, and also do the same thing if the research and development initiatives are applicable to them. Unfortunately, when it comes to R&D, most people only think about it from the perspective of biology and manufacturing and all that kind of stuff. In fact, in my webinar last Thursday, the example of the research and development initiative that I used, and this is a real life example, is one of our clients who is an Amazon delivery service provider. Between 2020 to 2024, he has spent about 420,000 plus just trying to implement little incremental marginal things that could enhance his service delivery in the routes that he's given to by Amazon. But with the previous R&D rule, he really could not tap into that. But with the way this new rule have been written, he now has the benefit of being able to really cash out of that 420. In fact, I titled my webinar last Thursday as cash in on the largest tax bill in the US history. So it's a big initiative. It changes a lot of things because this new rule even allows you to go back and amend the last 2-3 years returns.
All right.
Wow.
Interesting.
Oh yeah, I think that's something most people need to understand and know. And this client of mine, I actually sent him an email this morning saying, hey, this is something I want you to consider because he has not really tapped into the R&D that he has been expensing or he has been accumulating since 2022. Now he can amend 2024, 2023, and 2022 tax returns if he chooses to, or he chooses to expense all of that this year, 2025, and cash in on it. So it's a really big deal. With the 100% bonus depreciation, you can deduct the full cost of qualifying assets, right? Like machinery, vehicles, technological upgrades, right? As long as they are purchased and put into service on or before December 31st. Okay. So it's going to be very important that for business owners, they consider fast tracking any planned equipment upgrades or tech investments that they are planning to do this year. So that would be my definite call out. However, just like you asked, there are pitfalls to avoid so that you don't do the right thing in the wrong way or do the wrong thing at the right time. When you look at the bill, the entire 100% bonus depreciation is effective for assets that are put into service after January 19. So yes, you're right. That's something that people should be concerned about from the perspective of do not anticipate or expect that anything that you bought between January 1st to January 18 qualifies for that 100% bonus depreciation. Don't ask me why they put January 19. I would have.
Mhm.
It started January 1st, right? But it is what it is. So people must be very mindful about that. But most importantly to me, I always say to my clients, do not spend money for deductions. Okay? Rather, you should value invest only in assets or in research and development that will propel your business forward. So what do I mean by that? No, when people don't do great tax planning, it becomes a Hail Mary approach when it's November and December. And this is why I've really been all over the circuit talking about one big, beautiful bill. Because really, between now and the end of the year, people have many opportunities to do most tax plan. Or if you wait to the end of the year, you may end up just buying stuff, not because you need them, you'll be buying them because you're looking for opportunities and ways to reduce taxes. That's a major pitfall. And that really happens where people are not doing great tax planning. If you're doing good tax planning, you should be in constant interaction and communication with your tax advisor. Okay. you shouldn't be meeting with your tax advisor only once a year. So pretty much it's all about proactive tax planning, and anybody can really tap into what the new bill, big beautiful bill is all about.
Yeah, gorgeous. Well, it sounds like just green lights, race ahead so long as you've put some forward thought into it and they're things that you really need.
Yeah,
I do.
and it seems like there's quite a lot of guidelines and eligibilities that the clients obviously need to be aware of, and that's one of the things that you're talking about. And obviously, it also shows your expertise in your field. Now, you have helped clients save over $15 million in taxes over the past 7 years, with an average
Yes, I have.
tax saving of $31,000 per client annually. So can you please give us, what are we all missing? Why isn't this an outcome achievable for the everyday entrepreneur going in alone?
That's really a great question. Okay. I'll tell you really that for every one person that becomes a client of ours, there are likely 3 to 5 leads or prospects that do not become a client. Not because they won't be a good fit for what we do. The reality is, for many of those people that end up not being clients, what we say to them sounds too good to be true,
Mm-hmm.
right? And the reality is, there's just this love-hate relationship with taxes with most entrepreneurs. Now, most people go into business not having the right mindset about taxes. I always say to entrepreneurs, because I distinguish between an entrepreneur and a business owner. Anybody can have a business, and your business could be profitable, right? It does not make you have an enterprising mind. You may just have been somebody who is bold enough to take the venture of starting your own business. Now, the tax law all over the world, not just only the United States, it's only a bunch of incentives to make every one of us behave the way the government wants us to behave. But many people do not know that. And sometimes some of my colleagues criticize me because they feel like I am bashing on our profession. And I think it has been made worse by fellow CPAs and accountants like me, because most times many people, many tax practitioners are imputing and inferring into the tax law something that is not there. What that means is, when business owners come to them, instead of them truly understanding what the tax code is saying and be able to say, how can I get my client to be able to achieve what he or she is trying to achieve in a legal, ethical, and moral way? All they are saying to the client is, oh, no, you can't do that. So I typically say to clients, if you're going to work with us, you have to learn one basic rule, which is, don't come asking me if I can deduct this cell phone. A better question has to be, how can I deduct this phone as an expense? Two different mindsets. Because if you come and you say, how can I deduct this phone? My answer is, I don't know. But if you come to me and you say, how can I do this? Then I am going to be pulling a section of the code and I show you what the roadmap is. As long as you are willing to do the work of what the law says, then you get the benefits. Because I always say taxation is a fair game, whether you are rich or poor. Even though it is so maligned, people think the tax law benefits the rich. I'm like, no, it's very fair. If you play by the rules, you will get the benefits of it. If you want to be like the big boys, you got to play the game the way the big boys play. So, to your question, Kevin, many people find that too good to be true.
Yeah.
And they feel like, if this was so, why is everybody not doing that? Okay? Unfortunately, most people dread taxes. They just see taxes as something that the government uses to take money out of their pockets. But I see taxation as government incentives. That's what it is. When the government wants to incentivize behavior and pump money into any particular industry, the easiest way that they do it, they just do it by giving great tax benefits to that section. And that drives entrepreneurs there. Okay?
Yeah,
I hope
very
I answered that
insightful.
question, Kevin.
Yeah, that's
Thank you.
great. I really, it's never occurred to me to shift my mindset into seeing taxes as a positive, but I'm sure I'll be reformed by the end of this episode. So,
Yeah, my mentor says if you want to change your taxes, change your facts.
I love that. Perfect. You're flipping it on its head. So, Michael, circling back to the beginning, okay, we've got a bit of background now about all of your success and all of the wonderful things you can achieve for your clients, but give us the highlight reel of your entire career thus far. What are the moments that genuinely stick with you that mattered?
Oh, yeah, when you walk a journey, sometimes you're so busy walking the journey, you don't really have too much time to reflect backwards, right? Because it's always about the next hill, the next achievement, the next trajectory, and all that. But when I look back over my career, I kind of feel like it has really evolved around some typical inflection points. The first for me was leaving a secure corporate accounting job to launch my own practice, right?
Yeah.
Which which I did 18 years ago. Um, that leap taught me to bet on myself and embrace risk as a growth tool. Okay. I never forget. About a week or two before I was turning in my resignation letter in that last job, I was on a train ride back home with one of the vice presidents of the company, and I was just chatting with him and said, "Hey, I'll be turning in my resignation next week." And he looked at me like really crazy because for him, why would you do that? You are earning a six-figure salary, you are a C-suite executive, and all that kind of stuff. So he just felt I was crazy, and that's not going to be a reality. But I think what I get, like I said, it taught me that I am the kind of person that can embrace risk. And if anything, I have learned to invest more on myself than anything else. So that was my first inflection point when I look back to the last 20 years. I would say another pivotal moment was the year I really started specializing in advising entrepreneurs and business owners. The reason being, 80% of CPAs are still doing compliance work, right? All they are doing is historical and dated, right? I'm not interested in looking at a financial statement that's already 2 months old, okay? Because 2 months have passed subsequent to those numbers you're giving me. I need numbers that are really actionable, real time, as much as possible, so that I can drive forward. So that leap came around 2019, when I met my current mentor. And that really was a shift for me to understand that, look, shifting my focus from compliance reporting to high level advisory work and just helping clients not just to track their numbers, but to shape their financial destiny was really exciting. And that's really has helped our practice grow. Okay. I think most recently, I would say just building up our tax advisory practice and investing more deep down into technology and all that kind of automation has allowed us to continue to impact our clients' outcomes. So I kind of look at it high level from those three inflection points.
That's actually very motivating, and I can definitely tell that you are quite very passionate about bringing the financial destination to your clients. So, for you, I would like to know more on the vulnerable side of things. What has been your biggest failure in business recently, and how do you overcome that?
And we need the real answer, Michael.
We need the real answer. Yes.
Okay. I would say my biggest failure recently, that's a great question. My biggest failure recently is putting a wrong person in the right seats. Let me unpack that. At the beginning of this podcast, when I was introducing myself, I talked about our telehealth app, and I talked about another app that we will be launching in a couple of weeks. Now, this second app is an idea that I had way back 2019. I didn't get started on it until November or December 2023. And I hired the wrong developer to work on that project. But somewhere before summer this year, I started feeling like we had the wrong person in the seat because this developer could not take my ideas and put it into that tool that I wanted it to be. So the good thing is we've replaced this developer, but I would say that has been my most recent failure, meaning not doing the right hire for a time critical mission. So I don't know if you've read this book by Dan Sullivan, Who, Not How. When you read that book, Dan Sullivan is always saying if you are going to scale, right, it's not always about systems, processes, and all those great things that we all talk about. Most importantly, you need to have the right person in the right seat. I mean, if we look back to somebody like the late Steve Jobs was not the most intelligent person. He was a visionary, and he was able to surround himself with the right people who he was able to project his vision to, and they took the vision and actualized it in iPad, and all of the great things that have changed the world. So that, I would say, Kevin, is my most recent failure.
So I guess, well, for our audience who might be experiencing the same pain point in this moment, what is it about your new developer or whoever stepped into that seat afterwards that was a difference? What was it you looked for in them, and what should our audience be looking for?
The answer to that is simple. Are you familiar with the Entrepreneurial Operating System, EOS?
No.
Okay. So the Entrepreneurial Operating System, EOS, is a system that you can use to operate a business. And the EOS system pretty much tells you of the 6 things you as the business owner or founder should always be focused on. Okay? So one of them is people. Now, in the people segment, there's a tool which is called GWC. That tool says for any person that you're going to hire, you want to grade them or rank them against those 3 criteria. The G stands for, does this person get it? Meaning, do they buy your vision? Did they understand what this job is all about or what this business is all about? The W stands for, they want it, right? Because for many people, unfortunately, a job is just a bill paying mechanism. They are not passionate about it. They don't care about it. All they care about is they are clocking in and clocking
The
out.
benefit that they
They
get,
get
the
paid
benefit that
every
they
2
get. Yeah.
weeks. Right.
Yeah.
So if they don't want it, you can't infuse that fire into them. And then the C is, do they have capacity? Okay? Because the capacity is important. So I think when we hired our original developer, we did not test that developer against those 3 criteria.
No, that makes total sense. I mean, it's such a basic framework, but I suppose in the fast pace of developing things and trying to get to the deployment stage, I'm sure that it's easy enough to let it slip a little bit. But away from the hardest time that you've sort of overcome recently, could you take us inside your biggest year of growth and what changed that for you? What were the factors behind that connected directly to a jump in revenue?
I think I've mentioned it maybe indirectly. Our biggest year of growth is Smeed. I think it came when we repositioned ourselves from a traditional CPA practice to a strategic partner for entrepreneurs.
Was it an immediate thing, or did you have to did you struggle with positioning at all?
Oh, there was a lot of pain. There were a lot of pain in making that transformation. Uh, there were a lot of pain from the perspective of our team of employees. So, by the way, in our practice, we don't call anybody staff or employees, we call them team members. Our team members, when we started that transformation in 2019, they didn't believe that what we were saying we want to become is possible. They didn't believe it. Again, to that EOS model, do they get it? Do they want it? Right? They didn't get it. They didn't want that. All they wanted to do were, hey, most CPAs are kind of shy people. You don't see too many CPAs on podcasts. They want to hide behind their monitors and just do their work, right? But when you do advisory, you're going to do a lot of interfacing with clients. It's not about the client stays away from you at the end of the year, it's a mad rush to preparing tax returns. Okay. So that was our biggest year of growth in 2019 when we repositioned ourselves to becoming that kind of practice. And we transitioned from hourly billing to fixed value pricing. Okay. So even though we still keep timesheets, many times I have toyed with the idea of tossing away timesheet because we do not price our relationship with our clients on the basis of the hours that we put in. It's about value. So now we have fixed value price, okay, where we package CFO level advisory services, and we have dived deep into client education, okay, because many of us as CPAs are not great communicators. So what happens is, like doctors and sometimes the legal practitioners, accountants are speaking in some very high language. And really, many successful business owners don't even understand what we're saying. So I'll give you an example. In the webinar that I did last Thursday, where I was talking about bonus depreciation, I did not come to that webinar assuming that my audience understood what depreciation meant. I started, when I got to that point, I first of all unpacked in a language that a middle high school student could understand what depreciation meant, and how it is treated in accounting, and how it's typically treated in taxation, and why this change in law is a big deal. Okay? Because you could just go on and on talking about depreciation, and the business owner that is listening to you has no idea what you're talking about. Okay. So that's been our greatest year. And what happened to us that year was, because we were giving more proactive value, what kind of happened was we found out that our average revenue per client literally doubled. Okay. We had great renewal rates, and the referrals from those existing clients who were satisfied kind of came organically.
Of course.
Yeah.
So
So it seems like you basically trying to add more value towards the client. So instead of focusing on compliance work and just normal tax return financial work, you're going into more diving into what information we can grab from those statements and what I can then help them to reach that destination. That's essentially what you're trying to say, correct?
yeah, absolutely. Because most CPAs, we focus too much on tax returns. We do. And it's funny. And we feel or think that when we do a beautiful tax return and we give it to the client and we tell that client, oh, by the way, you owe the government 45,000, whatever the number is, the client should be appreciative of us because we've done a complete return. It's not the government job to tell a business owner that you have overpaid your taxes. That's why the government expects that you have a tax advisor. It's the tax advisor's job to be the advocate for their client. And believe me, we are not interested in clients doing anything illegal or unethical or against the law. I mean, the tax code is just, the tax code for me is a tool, not a trap.
Hey guys, just a quick break to thank our affiliate partner, HubSpot. We are thrilled to announce our partnership with HubSpot, the ultimate all-in-one CRM platform. HubSpot helps you streamline marketing, sales, and customer service with powerful tools to grow your business faster. From lead generation to automation, it's got you covered. By using the link in our description, you not only get to start your HubSpot journey for free, but you'll also be supporting our work here on the show. Now back to today's episode. Yeah, that's a big point of difference, I think, in your mindset for versus other tax advisors. But I suppose it's really interesting. It seems like you had some tension with your staff, and yet it was still a really successful pivot for you. Did you let anybody go, or did anybody leave on their own account?
When we made that change, we lost all, and I'm not joking, we lost every of our team members except one.
Wow. Wow.
Yeah. So literally, we rebuilt the practice, literally, in 2019, just before COVID hit. Because everybody left except one. That one is still part of the team today.
And
so yes, we
reaping the
lost.
benefits. Yeah. Wow.
We did.
No, I think that's a really good case study for people to be aware that sometimes if the people aren't the right fit, you need to just let them go and move on with your vision. That's a great case study.
That's very clear, yeah. And as business grow and changes, you're obviously finding different things to adapting to the new environment and the way the business worlds work. So yeah. Now,
but sometimes I think we get too emotional as entrepreneurs. Different people will belong to the story and the history of a firm or a business at different seasons of that business life. There will be people who were great at your beginning. Now, some of those people, if they don't have the capacity and the elasticity to grow, they may not belong to a next phase of the growth of that business. And so when a business grows from, say, 1 to 3 people to becoming 10 to 15 employees, it's a different vibe. It's a different energy. When that business grows from 15 people to 50, it's a different energy. So if somebody has been a great fit when it was just 1 to 3 people, he or she may not be a great fit for the next level of that firm.
Then that kind of leads up to our next kind of question in terms of you've been kind of through it all. It feels like you've been through it all, and you know your firm focuses on getting entrepreneurs to financial freedom in 5 to 7 years. Mm-hmm. That's a win. Now, if we handed you a typical profitable small business today, what are the first 5 levers you would put in that time frame, and in what order?
The first thing I would do is what we do in our practice to all clients, which is what we call the financial health assessment. Sometimes I call it the dream exercise. I know you both would have heard this. People talk of their vision board, right? We do a vision board with our clients on their finances. That's the first thing. And Kevin, you said something. The company is already profitable. I get that. But financial freedom for me does not mean retiring and going fishing, okay? It only means to me the flexibility, the opportunity, and the ability to choose to do what I want to do, when I want to do it, with whom I want to do it, okay? So what that means, if you can still remain on the saddle as the CEO of your business and not even be spending 10 hours a week on it, you are
What a dream.
financially free.
Yeah.
Yeah. So the first thing for us is we do that dream exercise. And the reason for that is we are trying to understand, where are you trying to get to as a business owner? In fact, when we say 5 to 7 years, it's because we make that measurement. When a business owner comes to us and we do that wet dream, they tell us what they are thinking, how soon they would like to get to whatever that financial happy place is. So what we try to achieve is make that journey shorter. And then, so that's number one. So the first thing we do after we've done that, if you want to cut that, the first grade, the second thing is we do the cash flow analysis. Okay? Because we want to dissect the past and project what the person's cash flow is going to be, because we want to identify what may be the leaks in that person's cash flow. I mean, the great thing, and I say this to my clients, they all know it. I say to every client, anything I'm telling you, know that I do it, except it doesn't apply in my case. So I'll give you an example. Because we do the EOS, I and my leadership team, we meet every Wednesday. So we met today. And I was kind of giving them my expectation of the cash flow numbers to hit our Q3 targets. And I was saying, look, the team needs to go back and identify leaks so that if there are any leaks which we can avoid, that will help us save some money. Then find scalable opportunities. That would be the second thing. The third thing, of course, which is what I'm most passionate about, is tax optimization. I mean, I cannot tell you what taxes can do to your financial freedom. So I was saying to somebody yesterday, good leverage and taxes make you rich. Okay? Because if you are not doing tax planning, taxation will be a weight on your ability to get to your journey. But if you're doing tax planning, I mean, you started this podcast talking about bonus depreciation and cash flow. Why is it a big deal? It's a big deal because if you save money from using the law, you have more cash available to invest in that business and scale that business faster than you would otherwise have been able to do if you were not doing tax planning. So tax optimization is the third one. Operational automation, it's my number 4, because we live in a world where knowledge is accelerating. I mean, it's crazy in a good way what is happening with AI, right? Just 2 years ago with ChatGPT, we were all starry-eyed. I cannot begin to tell you what I do today with AI. It's amazing. So a profitable business owner that really is wanting to get to that place of financial freedom, that must be a focus. And then lastly, figure how to replace yourself through processes and scalable systems. Okay. When I do work with entrepreneurs, I have what I call the cell phone test. Most entrepreneurs, they identify themselves by their business. They feel like their business is themselves, they are their business, right? And I'm like, okay, you're going to go on vacation for 1 week. And in this 1 week, you are not going to turn on your cell phone. Mm-hmm. Let's see what breaks. Because everything that breaks is an indication of areas of that business that needs to be fixed. Because, Kevin, we're talking about financial freedom. If you're going to be free so that you can say the business operates with or without you, you want to be sure there is no part of that business that is so dependent on you that the business cannot run.
Oh, I love that. I love that. That's a
Thank
totally
you.
new prospect to me, but there's so much value in that. And I guess it's sort of counterintuitive, isn't it? It's the slowing down rather than the trying to get faster. You have to force yourself to slow down and step out and see what's working
Yep.
without you. That's brilliant.
Yep.
The entity structure decision tree. So for founders doing $500K to $2 million revenue with healthy margins, how do you decide between LLC taxed as S Corp, C Corp, holding company, plus operating subsidiaries or professional corporation, and what salary distribution mix do you target in year 1 versus year 3?
I'm smiling just
Big
because
question.
I was in a tax conference last month in Park City, and the topic I spoke on was entity selection. Okay, so entity selection is so important for many reasons. It's important primarily for both asset protection and tax minimization. How your business is structured legally in your state helps to define the kind of legal protection you can have from the risk that happens in business. Okay. Now, how that business pays its taxes impacts their level of taxation. So you were talking about LLC that is being taxed as an S Corp or a C Corp or as a disregarded entity, which is a single member LLC. All of those have different impacts on taxes. But with the example that you just gave, 500,000 to 2 or 3 million, the reality is it's not a one-time decision. Okay? There is a longer term planning that any entrepreneur needs to do before they get into business. Because the things that will impact whether the company should be formed as an LLC and it should be taxed as a C Corp or as an S Corp, for example, can include things like what is the industry? Okay. What is the end game that the business owner has in mind? And I can unpack that. Who are the investors in the business? Let me give you an example. Now, you can have an LLC that has to file taxes as an S Corp. However, if one of the investors in that LLC is not a US person, then that LLC cannot be an S Corp because the tax code say all the shareholders of an S corporation have to be US persons. Okay. So those are important things to look at. So there's a whole list of what you should look at in making that decision. Unfortunately, most people just go out there, they form LLCs, and they don't really talk to both an attorney and a good tax advisor because you need both. You need that collaboration between a legal professional and a tax advisor before you make that decision. Okay. So it's a mix of many things. Now, you talked about a holding company and a subsidiary company. Yes, we do a lot of those entities structuring, especially for real estate investors. Okay. In a way that you can have many properties in different states. You may not want to be filing 10 tax returns for 10 different properties because you have the 10 properties in 10 different states. So there's a way you structure that so that they all roll up from their individual LLC into a holding LLC. And so you file only one tax return. So my point is there are just so many factors. Talking about salary, the IRS tells you you want to take a reasonable compensation if you have an S corporation. All right? Now, the reasonable compensation is a mix of many things. Again, this was where at the beginning I said something about people impute into the tax law what is not there. The IRS says a reasonable compensation. Now, two people can have the same level of business, the same level of profitability, but what may be a reasonable compensation to Kevin may not be a reasonable compensation for me. The reason for that has nothing to do with our lifestyle. It may just be because Kevin spends all his time doing C-level work in that business. Okay, so all the time he's doing work in that business, his salary rate is a very high one. But for me, maybe I'm the CEO, I'm the janitor, I'm the receptionist, and all of that. I'm spending many hours in low-level work and some on high-level work. So in building my reasonable compensation, it's going to be a mix of all of that. So those are the things that, so there's just a whole lot of factors. So when I'm working with clients, that's one major deliverable, entity selection and optimization.
Mhm. Well, you touched on real estate there. Let's go into that a little bit further. What do you use to decide when an operator should buy versus leasing, and what cost segregation is worth it on how to for avoiding passive loss traps and audit red flags?
Oh, okay. You're really pressing a lot of hot buttons, and we could stay here for
I know
hours.
we'll
All
need
right.
another episode.
So real estate is great to grow wealth, great for tax benefits. Now, one of the things you just said, I don't know if you know what we call it. We call it the pigs versus the PAS, meaning passive income generators versus passive activity losses. And I get what you are driving at. And just so you know, now you're making me bring the cat out of the bag. This app that we are developing has to do with real estate professionals really being able to track their time in a way that the second guessing will be taken out of that minefield, and they can be sure if they are being audited, they will pass their audit. That's what this new app is. Now, real estate, like I said, is a great opportunity. Yes, there are traps. The traps come from Section 469 of the code, which way back 1986, when they passed that new law, the government pretty much said, look, real estate rental activity by default is a passive income activity by default. So the question becomes, if you take a physician, a dentist, or any high W-2 wage income earner who is making a lot of money, in the past, they could just buy real estate and they generate losses by reason of depreciation through cost segregation, and then they reduce their taxable income because of those losses. Okay, cost segregation is great. In fact, I feel it's professional practice if a CPA is not recommending it to their clients. Okay, because I'm so tired of my profession just being 10 years behind. Now, when you have real estate, you want to look at the profile of the taxpayer. So let's say, for example, take ourselves a dentist. Let's say the woman is a dentist and the man is doing some other things. You want to look at that two taxpayer and say, is there the possibility of us being able to qualify one of them to become a real estate professional? Because if you can qualify that person to become a real estate professional, believe me, depreciation is magic. And cost segregation puts your depreciation on steroids. Okay? And so what that does for you is it allows you to accelerate your deductions. Remember, taxes is all about cash. Every year that you can save on taxes by way of the cost segregation that you've done, that has given you bigger depreciation, you reduce your taxable bill. The money you've saved, you can take that money and buy the next real estate deal and just continue that velocity in that cycle.
So, what's a great question for clients to come to you with if they're interested in getting better at what they're doing with real estate? What's a great question they should ask?
Great question will be determining for themselves their criteria on what kind of investment they make in real estate. In fact, I will be recording a course on that this Saturday. Okay, because I just feel it's so important because there's just so much. So one of the challenges most people who get into real estate face, they have paralysis analysis. they get overwhelmed from what kind of property do I need to buy or invest in? Do I invest in residential? Do I invest in commercial? Do I invest in storage units? And yes, if I choose to do residential, should it be single family homes? Should it be duplexes? Should it be apartment buildings? What states should I invest in? And there's just gazillion things that really you need to think through in making that decision. But in our firm, we've come up with what we call the 3-minute decision. The 3-minute decision for us is we walk you through a process where you, as the real estate investor, you determine your cheat sheets of what will guide you in making your selection of the properties to invest in. And those criteria must align to your wealth dream. Okay. So what do I mean by that? If your wet dream says, oh, you want to be financially free in 5 years, and we look at what you own today and where you say you try to get to, you cannot be going into real estate cash flowing investment maybe when they are using only a 3 to 5% rate of return. It may not work. That's just a pipe dream, right? So when we look at your wet dream, the first thing we want to say to you is, okay, what is the kind of real estate investment activity that will give you a return on investment that will help you get there within the next 5 to 7 years? That should be your first goal. And then some of these criteria may be subjective. I have a client, he says, look, Michael, I don't want to be a slumlord because I don't live in a slum.
Sure.
So when he is buying property, he only buys Class A properties. He doesn't buy Class B or Class C. That's one of his criteria. So for him, his properties that he buys, they need to be brand new, they need to be high end and all of that. So once you develop your own set of criteria, it becomes a cheat list for you. So when people are throwing thousands of properties at you to look at, you are asking yourself, does this property meet or align with my 5 criteria? If they don't, you throw it away. So that's why we call it the 3-minute decision.
I love that.
Now, you talk about a lot of kind of tailoring your advice to the client's need, right? That's basically what you're trying to say. Talk to us a little bit more on the compliance side of things. So what should the first-time finders know right now about the Corporate Transparency Act beneficial ownership reporting? Who must be filed, and the biggest pitfall that you are seeing?
Well, I don't know if that act is ever going to come back. Just so you know, it's been tossed. Nobody, I mean, we did fight some of it for some people, and then there were just so many iterations of one court stopping it, another court bringing it back, and finally it just died. Okay, and believe me, I'm happy it died because it was just one compliance need that I really could not truly find any. And I get it in a place like Europe, they have a whole lot of such things that I think the US government started feeling there were some concerns as to who really was the owner of these entities. Yeah, but I honestly feel that's a dead issue.
So not
I don't
really,
think it's going to come
so
anymore.
not as relevant as your practice today and what the future
No,
will.
no,
Yep.
no. The BOI was a waste of everybody's time, and I'm very glad and happy that it's dead.
Fabulous. All right, we'll throw a party. All right. So Michael, let's zone out for a second and look at the industry at large. What is the best of CPA culture today versus what are the worst things that you still see being practiced?
The worst challenge with our profession is accountants seems to have been trained to be afraid of money. And so we erroneously project our fear of money on the clients. That's why many times many business owners are very frustrated with accountants. They're frustrated with accountants because a business owner, most cases, is a risk taker. Is somebody that is growth minded. He or she is most cases optimistic. Accountants, maybe by training or otherwise, they tend to be so conservative, right? And like I said earlier today, many of us impute into the tax code what is not there. So I think that's something our profession must be very mindful to change. Our job is not to be, like you already said, be giving outdated reports. Our job is to be very relevant advisors to guide our clients. In fact, when you look at this on the spectrum of trust of professionals, accountants are highly rated in terms of the trust equity they carry. Okay. An accountant is going to know so much about their clients that even their spouses may not know. I mean, I joke about it. I said, I'm both a therapist, I'm a CPA, and all of that put together. Because there are times when a client comes on my camera, I can see that there is a whole lot bothering it, gentleman or lady. Now, if I'm just rushing into business with him, he may not even hear half of what I said in that 1 hour session. So there are many times my team members are surprised because I go into a meeting and I see that this person is not there. I want to first of all connect to the humanity. And I genuinely ask what's going on. And when I'm asking that question, I'm not trying to make conversation. I'm trying to connect to his soul as a person. Okay. So I think accountants have to do better in really being humans. Yeah. So we project our fear of money on people. I think that's the worst of our culture. Okay.
Just not another number on your books, another person that comes in and pay for your bill. Is someone that you can try to connect with, learn their stories, learn about them to understand better for their business.
Michael, this has all been so insightful. We're getting toward the end of our time, unfortunately. So let's get into the fun stuff. We're starting a new segment where we'd like to invite you to pass on a question to our next guest, and we'll ask it in the next episode.
I think my question for your next guest will be, how do they intend to incorporate AI and robotics to 10x their business?
Yeah, we want that 10x factor on the back of it. Gorgeous.
That'll be my question.
Yeah, perfect. We'll pass it on. We'll let you know what they say.
Now, to finish up, Michael, where can people find you and your company online? What's the best way to reach out to you?
There are so many ways people reach out to us. An easy email address is taxes, TAXES, taxes@smeedcpa.com.
Gorgeous.
That's an easy way to reach out to us because I get those emails. We have a series of video libraries on school platform, SKOOL. It's called the Financial Freedom Academy.
Perfect.
Okay. So if you type in school.com/Financial Freedom Academy, one word, you will get access to that community and you can become a member of that community and interact with us.
Fantastic. All right. Well, I guess that's a great way for our global audiences to connect with you as well. It's been such a pleasure having you on. And honestly, I think you've made tax sound almost appealing and exciting and something I want to participate in. So thank you so much for your time today.
Thank you. Thank you.
Thank you, Michael.
All right there. You all have a great, great, great day.
You too.
Bless. Thanks.
To help support our continued mission to provide free, best-in-class advice from the world's most compelling business leaders, make sure you hit that subscribe button and ring that bell so you never miss an episode. See you next Thursday. Thanks for tuning in to The Business Game. If you like what you've heard, make sure to subscribe on YouTube and follow us on TikTok, Instagram, Facebook, and LinkedIn to stay connected. A big thank you to our major sponsor, SmoothX, for powering today's episode, and join us again on the next episode of The Business Game, a podcast that moves the needle.